Good morning. I'm David Rowett. I work for Strategic Exits Corp. I'm going to talk to you for a little while this morning about how to prepare your technology company for an exit. First, a little bit about Strategic Exits Corp. We're a boutique investment bank that works solely for technology company founders and their angel investors to achieve the optimum exit transaction. In other words, we help your technology company sell for more. So about this presentation, I'm going to talk a little bit about why this is the best market for mergers and acquisitions in quite some time, if not forever, and why it's a good idea if you're thinking about exiting to start the process now. Many successful exits depend upon taking advantage of a market opportunity in timing, and there couldn't be a better one than the present time. But the more preparation you have done in advance, the less delay when time may be precious to get an acquisition done during an open market window. So this presentation will outline the many tasks you need to complete so that your company is prepared for an exit at the earliest opportunity. So a little bit about me to start with. My name is David Rowett. I've got engineering degrees from the University of Waterloo and from University of British Columbia. I did my MBA at the Harvard Business School and returned to Vancouver to help uh, early stage technologies grow and be successful. And in the last 35 years, I've worked with over 70 technology companies at various C levels, including Chief Operating Officer, Chief Executive Officer, and the Chief Financial Officer. Currently, I'm a partner with Strategic Exits Corp, and it's in this context that I'm making this presentation to you this morning about preparation for an exit. There are some macro trends in the economy with large companies and with early stage tech companies, which are all converging to make this an exciting time in the mergers and acquisitions opportunities for tech companies. First of all, on the macro side, the central banks have been flooding the economy with cheap money for, well, years now, trying to keep the economy moving when after the meltdown in 2008 and during the pandemic crisis, which we're just coming out of now in June of 2021. There's lots of excess cash out there that needs to find a home to generate returns for investors. And at the same time, interest rates are at historic lows, so it is very cheap to borrow money to leverage acquisitions. On the corporate side, it's been known for quite some time that big companies really have a hard time innovating. Trying to bring new ideas into a process that's mired in bureaucracy is just it's just not working, and the companies are realizing that. And in order to keep abreast of the new technologies, it's easier to acquire them, especially now while they're sitting on excess cash with new buyers entering the market. We're also seeing private equity firms becoming more aggressive in acquiring technology companies. So big companies of all sizes are working more towards acquiring the technologies that they need by buying technology companies than to try and develop the technologies on their own. Within the technology sphere, we're noticing that startups, especially virtual companies that have no physical head office where everybody's working online, they're leaner, they're meaner, and they're more agile than they ever have been before. So they're able to innovate faster and create new opportunities much quicker than they ever have before. And so that plays into the hands of large companies that are looking to buy new technologies, because new technologies in the form of early stage companies are presenting themselves for acquisition all of the time. So with that, we're seeing that it is a prime time for exits because the macro corporate and technology trends are all pointing in that direction to create a burgeoning mergers and acquisitions market at the present time. So I mentioned that big companies are acquiring. We're seeing that the number of acquisitions are accelerating. They took a bit of a dip at the early start of the pandemic in March of 2020, but the rebound is spectacularly after that. And currently in Q2 of 2021, the number of acquisitions is accelerating. Now, what's interesting, of course, is that when a big company buys a little company, they're interested more in the value of their technology rather than the size of their business. So it's the technology that's important, not the revenues and the profits. And large companies won't pay that much more for additional scale unless the company is profitable and growing quickly. But they will pay for exciting opportunities or exciting new technologies, which they can own all of their own. And so this is fostering a trend towards acquiring technology companies earlier and earlier in their corporate development. Now, there are some common misperceptions about mergers and acquisitions when it comes to early stage tech companies. And these mantras are repeated so often that people have basically bought into them because they've heard them so often. But one, for instance, is the mantra is to focus on the business and the exits are a distraction. Well, this is absolutely not true. You create more value for your shareholders, and of course, that's your job at the end of the day is to maximize shareholder value. More value is created by managing a well-run exit, and by managing a well-run exit than it is by happenstance waiting for someone to come along and make an offer to buy your company. And that's the second mantra, that the exit will always present itself at the right time. Well, that's not necessarily true either. Waiting is always a risk. The longer you wait, the more likely that you'll bump into some operational problem, or the business climate may change, your technology may become obsolete. Time is not on your side when you're a tech company looking to exit by selling to a big company. You want to take charge of the process and manage it on your own. If you're waiting for a company to come along to buy you, then you've only got one buyer, and that's not the best negotiating position to be in when you're trying to settle on your price. And finally, the longer you wait, the longer it is before your investor receives a return on their investment. And of course, their return on investment goes down as a result. So when you hear those mantras about exits taking care of themselves, or uh, build a better mousetrap and the world will beat a path to your door, take that with a little grain of salt, because in most cases it really isn't true. The exit is a fundamental business process. It's not something that happens by accident, but many companies treat it that way. Every company has an exit strategy, whether it's a deliberate, planned process that's part of their business operations, or it's implicit in the sense that they aren't really planning on it at all, and therefore they're just hoping that the exit will come along and present themselves at the right time. But as we've said, a planned exit is more likely to succeed because you're spending time on it, you're taking care of the details, and you're managing the process as if it were part of your business, which it really is. Your exit strategy should drive your entire business strategy, because at the end of the day, an exit strategy that delivers more value is giving more value to your shareholders, which is the ultimate goal of any company. So it's best to make the exit part of the strategy from the very beginning. So let's talk about strategy and planning and timing of an exit. An exit can take anywhere from 6 to 18 months from the time that you first engage the mergers and acquisitions professionals until the cash is in the bank from an acquisition having taken place. Now, exits will take shorter when the shareholders are all aligned and everybody is working together in concert. When the company documentation is full and complete and ready for inspection, and when all of your financial statements and models are in order. That's what makes a short exit, one that might take closer to 6 months rather than 18 months. But on the contrary side, when the stakeholders are not aligned, and that's generally going to mean a failure of the exit right from the beginning, as we'll talk about. If the company documentation isn't ready and the financial reporting isn't up to scratch, then it's going to take longer to complete your exit, obviously. So that's when you get it towards more the 18-month time frame rather than the early exit, which could be in a 6-month time frame. So if you want to look at ideal exit timing, here's a graph that shows a company that starts and grows very, very quickly. You want to start your exit process very early on, when you've proven your business model so that you know that if you got something that's valuable to sell. And the optimum time to exit, of course, is when the company is still growing strongly. So you want to start the process when the company is growing quickly, and so that you can complete the process while there's still lots of growth in the company, and you can attract the highest price. But what often happens is that for those companies that don't have an explicit exit strategy, they're waiting for something to happen. They only start thinking about the exit after they've gone through the top of their valuation, and it's starting to slide down on the other side. So that's when they start the exit, because they're trying to get out while they still have some value in their company. But what typically happens is that as a result of waiting too long, the exit is not successful. It blows up in their face, and the investors get a return of zero. Yeah, so that's quite true. A misplanned or a misrun exit can actually cause the company to fail, and everybody loses all of their money. So hopefully we've convinced you that an exit should be planned, and that there's a preparation that goes into it. And that's what I want to spend some time on this morning, talking to you about the various aspects of the preparation that needs to be done so that an exit proceeds as smoothly as possible. So there's a number of things that you need to take place on a macro scale. First, you need to build alignment of all your stakeholders around your exit strategy. You need to prepare the due diligence so that it's ready for inspection, and that means putting together a virtual data room and completing all of the financial history and projections into the future as part of the data room. You need to create some collateral to promote your exit, and if need be, you may need to spend some time cleaning up your corporate structure so that it's simple for an acquirer to manage to acquire. So the first thing to do is to check the alignment amongst the key stakeholders. And what we've noticed in our practice over the years is that many key stakeholders often disagree on the exit strategy. For instance, among the founders, they may not have a set valuation because, of course, they've earned their sweat equity. So any exit that they take is money that's in their pocket. They don't need to show a return on any investment that's made because obviously any investment is giving them a 100% return. But amongst the founders, there may be a disagreement. Some may want to continue to build the company, while others may be tired or had enough of this particular technology and they want to get out. So, a fundamental difference on the timing of the exit. The angel investors may have different priorities as well. Some angels that we've seen are quite happy with the 3 times return if they can get it fairly quickly, while others would rather wait for the process to play itself out over 10 or 20 years. Well, maybe not 20 years, but they're quite prepared to wait for a 10 times or even a 30 times return because they're wanting to see the biggest exit that they can. Venture capitalists now have a mandate. Most venture capital funds are required by the terms of their construction that they must achieve at least a 10 times return, or they will seek to stop the exit until they can get a 10 times return. So this obviously will put them at odds with angels who are happy with a smaller return and with the founders who are not set on a particular valuation to begin with. So these are all misalignments in the attitudes towards an exit that the founders and the investors may not even realize that they exist. But when there is a fundamental misalignment like this, for sure, in our experience, the exit will not complete. It will crater, and there may be lingering, lasting damage to the trust amongst the founders and the investors if they start down a process only to find out that they weren't all aligned on the outcome. So it's very important to build alignment around your exit strategy. And this often needs to happen as part of your annual strategic planning retreat, where you're off site so that you're focused solely on the object at hand, which is to agree on what the exit strategy should be. But even at that, it's often not a perfect process because people can come away from a conversation that all nodding their heads about what they thought they agreed on, but only to find out much later that in fact there was a great deal of misperception around what they thought they agreed on and they hadn't really agreed at all. But it's also the case that if you write it down, then many of the disagreements will expose themselves just by the fact of putting it to paper. So it's very important that when you've come up with an exit strategy as part of this offsite retreat, that you write it down then and there and pass it around the table so that everybody takes a look at it and make sure that they're aligned with the goals and the strategy and the timing and all of the other things that are in that strategy. This is what forces alignment around the exit strategy. And you should sign it because signing it, once you put your name and your signature to the plan, that really does force the alignment. And if there haven't been any disagreements exposed at that point, they surely will at that point in time. And it's important because business changes quite quickly, particularly in the technology industry, that you check back annually to confirm that there is still the alignment around the exit strategy. Now, something that's less exciting that we do have to spend quite a bit of time talking about is the documentation that you need to prepare for your exit. So we're all working and have worked in early stage technology companies. And it's the case that early stage tech companies often do not maintain good records, and for a very good reason. That building the business is more important than keeping track of the paperwork. And frankly, it's a boring thing to do. So companies tend to leave it to accumulate, for a time when they can get around to it at some point. That point is often the exit, because you cannot exit without solid documentation. It has to be complete, and it has to be all intents and purposes flawless, because the buyers will do extensive diligence looking for flaws, and every flaw that they find is ammunition for them to negotiate a lower price for the acquisition. So it's something that you do have to take care of, and the sooner the better. But it's not all time that's duplicative, because if you've been through a financing, then much of the preparation you did to bring money into the company is the same type of documentation that you need to put together to plan for your exit. So there's some documentation that needs to be done now, and some that can be done later. And I sort of categorize these in three different ways. Category one is the documentation that you do once and you archive it and you don't have to think about it again. Category two is documentation that you need to do continuously to keep up to date, but you need to keep it as simple as possible so that you don't have to spend too much time doing it, because of course you have a company to build, and that's what's more important. And of course, category three is the documentation that you do just at the time of the exit, some things that you need to bring up to standard to prepare for the exit, and other documentation that you do in anticipation of a buyer coming to look at your documentation. So the important point is to start now and discover and fill any holes that appear in the documentation while you've got lots of time to fill them and correct the documentation. Much better to do it before the exit process starts than to have it delay a process and hurt the credibility of the founders as the buyers are looking over documentation that isn't quite ready. The first key item in the documentation is intellectual property assignments. This is a category one. So it comprises non-disclosure and intellectual property rights assignment agreements. And every employee, every consultant, every director, even the corporate janitor, must sign one of these NDAs and intellectual property rights assignment agreements. Because what they do is to ensure that all of the intellectual property that the company has developed is remaining within the company, and it's the full and sole priority of the company with what to do with it. You don't want to be in a case where someone may have worked on the technology casually as a consultant sometime way back at the beginning of the company, only to find out that they hadn't signed a rights assignment for the IP, which means that they have a claim on it. And what that means is that it's a showstopper for the investor and the acquirers, because they will not buy a company unless they're absolutely sure that all of the intellectual property necessary for the success of the company is owned by the company. And we've seen deals that have fallen apart because some of those rights assignments agreements had not been put in place, and therefore there was no certainty around the ownership of it, and the investors just walked away because they weren't prepared to take the risk of someone coming out of the woodwork sometime later and making a claim on the company and its technology. So there's no time like the present. If you don't have all of your IP assignments in place and your NDAs, now is the time to get them in place so that they're done once and you don't have to think about them again. Financial statements. Now, startups can manage for quite a while without having financial statements while they're building the company. But of course, when it's time to exit, financial statements become critical. All external investors will demand them. It'll be the first item of diligence that they look at, and they certainly won't engage seriously in the exit process until they have some financial statements that they can look at and review. So I call this a category two because it's something you have to keep doing on an ongoing basis, is maintaining your financial statements. But you can keep it simple. You can prepare them on a cash basis as opposed to a GAAP to begin with. You can employ a junior part-time accountant whose only job really it is to pay the bills and to keep track of the cash and the commitments, so you've got good control of your money, so you can see it where it's been spent and where it's committed to be spent. So this doesn't require a full set of GAAP compliant financial statements. You can do these in a cash basis in QuickBooks or Simply Accounting or some equivalent software that is designed for non-accountants to use. But you should do them about monthly, because if you leave it longer than that, then it starts to get unwieldy to try and bring them up to date when an exit starts. And speaking of generally accepted accounting principles or international financial reporting standards, at the time that you engage the exit process and you're starting to look for buyers, then you have to bring your financial statements up to scratch in a format that buyers are used to looking at them. And although the standards are different from country to country, each has a slightly different flavor of GAAP or IFRS. Typically, there are common standards that everybody uses. And in the case where you expect that your acquirer is most likely to be a U.S. company, then you should convert your financial statements to U.S. GAAP because that's what your acquirers are used to looking at. They understand them. There's no item of disagreement about how the numbers are treated. And of course, bringing your statements to be compliant with GAAP means that they're ready to be audited at the next stage. So a review or an audit, this is something that is that investors and most acquirers will want an independent review or audit of the financial statements to know that an expert third disinterested party has looked at them to make sure that they are correct and present an accurate financial picture of the company. Now, you don't want to take on an audit or review unless you have to, because it's expensive and it's very disrupting to the operations of the company when you have auditors poking around asking questions at all inopportune times. So the time to do your review or your audit is when the acquirer who's taking an interest in your company, when they ask for one. They have the right to ask for one. Many will, and that's the time to engage your external accountants to get the review or the audit done, so that it's an item of diligence that the acquirers can then review. So in choosing your auditor in Canada, there's basically three levels of accountants that you can look at. The big four, who everybody has heard of: KPMG, Deloitte, PricewaterhouseCoopers, and Ernst & Young. These are the brand name most highly reliable accountants that everybody knows and relies on. They're reliable. No one will ever doubt the work that they do, but they're unfortunately very, very expensive. Now, some investors and acquirers may demand that you have a big four accounting firm audit your business, particularly if it's an ongoing business that has grown substantially and there's lots of aspects to the business. They may expect an audit. Sometimes if your company is much smaller and is much simpler, a review, which is much less demanding and much less expensive, that may be adequate. At the same time, if you're an earlier stage company, most acquirers will accept a second tier firm like BDO Dunwoody, Grant Thornton, Manning Elliott, a firm like that, which is not as highly well known as one of the big fours, but is certainly a very reputable and a reliable firm. And they will do an excellent job of auditing your company if your acquirer will accept it. Now, the third quality of accountants are your local storefront firm, which you can find in many shopping malls. No one is going to accept an audit that's done by a firm that they don't recognize. And so there's no point in even looking at a storefront firm. It may save you lots of money, but it won't get you where you want, which is an independent review that people will trust and engage with. Now, as part of preparing your financial statements for review by a potential acquirer, you need to calculate your adjusted EBITDA. And EBITDA, for those that don't know, are your earnings before interest, depreciation, taxes, depreciation, and recently the amortization of stock-based compensation. So, although GAAP is the international standard for financial statements, in the mergers and acquisitions business, everybody uses adjusted EBITDA, even if it's not GAAP. It's the best means for valuing the company, and you can easily turn your GAAP statements into adjusted EBITDA by the accounting adjustments that need to be made, which are somewhat laborious, and I won't go into them in great depth. But there's something that should be done as category 3, just as you're starting your exit. Now is the time to invest in calculating your EBITDA. And what it does is in adjusting the EBITDA for acquisition purposes, it removes the peculiarities from your statements. For instance, personal expenses that may be paid by the company, or special deals that you've negotiated with people that aren't at arm's length for, say, cheap rent, or having family members working in the company, paying them non-market compensation, either too high or too low. You've got to remove and adjust for all of these things so that when you're finished, the adjusted EBITDA reflects the earning power of the company when the buyer runs it. So it's going to be a projection of how the company will perform once it's been acquired by the buyer. And of course, that's what they're looking to see in terms of making their evaluation of the value of the company. Once you've got your EBITDA figured out and your statements in GAAP format, Then it's time to prepare a financial model. And this is a category 3 item because it's something you want to wait for until it's asked for, but invariably your acquirer will want to see a financial model that comprises essentially 3 components. 3 years of annual historical statements. And the easiest way to do this is to directly link them to your accounting system. In fact, with QuickBooks, you can take the chart of accounts and excerpt them from QuickBooks and stick them right into your financial model, and then your financial model can directly review or link to the numbers from QuickBooks, so that there's a one-to-one correspondence between your actual financial statements and your financial model, which of course is a great relief to the acquirers, because now they can rely on the numbers in your financial statement. They aren't made up. They don't have to be validated, because they already are, by directly linking them to to QuickBooks or Simply Accounting, whatever you use. The next portion is the current year and the next year, where you need to prepare a monthly budget and a set of actuals, so that as each month goes by, the budgeted figures are replaced with the actual results for that particular month. And so what you have is a constantly up-to-date historical and current budget and actual, so that the acquirer can see exactly how the company is performing in real time. You want to include the normal adjusted EBITDA as part of this monthly budget and actual, so that they can track the EBITDA as it's changing over time, and get a sense of where it's going to turn out at the end of the fiscal year, because that's typically what they base their valuation on, is the ending EBITDA value of the year that you're in. Finally, the third component of the financial model are the annual projections beyond the current budget period, 2 or 3 years into the future on an annual basis. So this gives the acquirer an idea of what the growth rate of the company is likely to be, and this will help them in their valuation of the value of the company, what they're prepared to pay for it. Finally, you should include simple bar graphs showing the annual revenue and adjusted EBITDA, and color code them to distinguish the actual historical numbers from the projected numbers, to make it easier for the acquirer to center themselves on where in the process these numbers are coming from. So, just to review, because this is a key point and it's going to take a lot of time to pull this together, is that you need a financial model which pulls together the annual historical results with 2 years of monthly budgets and actuals, and 2 years of annual projections into the future, so that in one model, one giant model, I might add, you have all of the history, the current performance, and the future projections, which makes it much easier for your acquirer to do their financial analysis. Excuse me for just a sec. Now we come to the quality of earnings report. And this is something that we're seeing more and more acquirers asking for, even for fairly early stage companies that are just at the beginning of their revenue and earnings cycle. And what a QofE report, it's a It's a report that looks at the reasonableness of the historical financial numbers and your projections into the future. And that's how it distinguishes from an audit of your numbers. An audit is always looking backwards in time, where a quality of earnings report is looking at the audited and the normalized adjusted numbers, but using them as a basis for looking forward into the future, so that so the acquirer can see what the recurring income statement and is likely to look at over time. So although it's prepared according to a GAAP, they will likely include a reconciliation to EBITDA. And what this does is to give the acquirer a third-party reasonable review of what your projections are looking like into the future, looking at essentially the recurring revenue, the revenue that can be expected to recur from time to time, as opposed to one-off items that may be just one spectacular deal, but not one that's likely to be created in the future. So this is all important to the acquirer, so that they can base their value of the company on numbers that are likely to recur from year to year as the company proceeds into the future. So obviously a very important piece of data to have to help the acquirer come up with a valuation for the company. And that's why we're seeing it requested more and more often in our work. So something that's less exciting, which I like to call corporate janitor work. And some of this is category one that needs to be done now and can be put away to forget about until the acquisition actually is in process. But acquirers and investors need to confirm that the company was properly formed and established at the very beginning, and that all of the shares in the company have been legally issued. So, obviously very important so that the acquirer knows that they're buying a bona fide company. Mistakes are often made at the early stages of founding a company because, quite frankly, the entrepreneurs don't understand the process particularly well, and they saved on legal fees by not having a lawyer do it properly. That will come back to haunt them because if the mistakes are serious, they may end up having to be fixed in court. And I was the unlucky CFO one time with a company that had not formally created a specific class of shares properly, and we actually had to go to the British Columbia court to have the matter rectified in front of a court of law, in front of a judge, to ensure that it was done properly and that the share structure could then be replied upon. This is not something you want to have happen, so better to take the time at the outset to make sure that all of the mistakes in the issued and outstanding shares have been taken care of so that the acquirers don't need to worry about that when they're looking at doing their diligence. So this is a busy and boring work for the chief financial officer or corporate secretary and often the company lawyer, but it's absolutely critical because unless it's done properly, the exit will not proceed. It'll be stopped in its tracks. So a couple of items of corporate janitor work. One that I'm sure you know about is the minute book. And this is maintained by the corporate counsel at the Register and Records Office. And inside the minute book, you'll find all the incorporation documents, the ones I just mentioned, category one, that need to be done at the outset and properly filed. All meetings or all minutes of the board meetings, all of the share certificates that need to be in the minute book, and all of the forms confirming who the current directors and officers are. Boring legal stuff, but it's something that needs to be done. And inevitably, you may find that there are problems in the minute book that need to be corrected. And this is why we suggest that you do it now before it holds up a potential exit. So the CFO and corporate secretary should review the minute book to make sure that all the minutes are signed by the chairman and secretary, that all of the original share certificates are present and that they have been signed by an officer of the company. And if you made the mistake of sending out the original share certificates to the shareholders because they asked for them, this is the time to get them back and to give them copies if they want some for their records, because the exit will not proceed unless all of the original share certificates are signed and in the minute book. It's absolutely critical. You also have to make sure that every share issuance has been approved by the board, either by resolution or by meeting minutes, and that every financing offer and term sheet has also been approved by the board, which is something that a lot of people don't know, is that when you create a term sheet to raise financing for the company, the board must approve it by virtue of a minute in a board meeting or by resolution that they have all signed. And the company counsel must also agree that all of the minutes are in proper place and that all of the share certificates have been validly issued, because they have to write a legal opinion at the time that your company is being sold that states that on their expertise as a legal, as a legal representative, that they agree that all of the share certificates have been properly issued. And if they haven't been, he can't write the opinion and the exit stops again. So again, not terribly exciting stuff, but it's absolutely critical to make sure that your exit can proceed as quickly as possible. The next document is the Central Securities Register. And this is a document that typically is kept by the CFO, but it may also be kept by the lawyer, just depending upon the company's preference. But what this register incorporates is every share certificate is a document that documents every share certificate that's been issued and canceled. And it includes the name and the address and other shareholder data, the number and class and the date of all of the shares that have been issued, the date that the board approved them, either by resolution or by board minute. They're all in chronological orders, and they obviously have to match one-to-one with the minutes and the director's resolutions with respect to approving each one of these shares. Now, the next thing that your acquirers are going to look for is a share cap table. And this is something that's a category 2 item that your CFO or a corporate secretary should update just before and just after any share or option award to make sure that it's always up to date. And typically it's an Excel model that breaks out by shareholder, the total shares that are owned by that shareholder, and also the warrants and the options that they may have that were issued with respect to work that was done or a financing that took place that they invested in. You'll see subtotals for the numbers of fully issued and outstanding shares, and then a fully diluted position for including all of the options and warrants which have been issued. And it will look something like this. Here you can see this is a very simplified version of a share cap table, and so you see the common shares that were acquired by Mary, Henry, and Iqbal. It shows the number of issued and outstanding shares and the Series A shares that Bob and Lisa had, and so the total for the issued and outstanding shares are 575, representing 100% of the issued and outstanding shares. Then the next columns over includes the warrants and the options, which increase the fully diluted number of shares to 760, and then shows the percentages that each shareholder owns as a percentage of the total shares that have been issued. So something that should be familiar to all of you, because anytime you've done a financing, you'll have had to produce a share cap table in this format or something like this. Another chart that I like to produce, which shareholders have found particularly happy or very beneficial to them, is a financing history sort of done in a nested format like this. Each nest, let me just grab a pointer here, point this out. Each nest you see, which is bounded by the blue lines, is essentially the outcome of a specific financing. In the first case, it would be the founder round, where 1,000 shares were issued, representing the total in the company. The next issuance, say in September of 2020, might be a friends and family round where they purchased another 300 shares. So the total is now 1,300. And then the third round being an angel round in June of 2021, where they sold another 200 shares, making 1,500 total. And what you can see is that the founder shares are declining as a percentage of the overall total, but as the number of new shares that are issued to people who are investing in the company. So the idea being, and you can actually add this into the financing history, is to show the increasing value of the company and the value of the shares. If you show them increasing over time, then what you might hopefully see is that even though the founders are decreasing in their percentage ownership, the value of their investment is growing up as the share cap, as the value of the shares increase as the company continues to build over time. Now, simplifying the corporate structure is something that if you can do it, you should do it. And the challenge here is that many companies, have a very complicated share structure. They have shares that are owned by individual founders, but the founders may have their own corporate entity that they want to have own the shares for tax purposes. And you can find very quickly that you have a very complicated share cap table with a number of founders, angels, corporate entities, which all make it very hard for an acquirer to understand exactly who owns what shares in the company and which shares that they're going to be buying at exit time. So to the extent that you can simplify your corporate structure by reducing the number of shareholders and the number of different classes of shares, it's advisable to do so, because the simpler the share cap table is, the easier it is to understand, and it's less of an impediment to an acquisition. But having said that, it's very difficult to simplify a corporate structure, because it means that somebody is going to have to give up some rights that they purchased previously. There could be some change in the status of the shareholders, which may not be acceptable, and it can create an unholy mess to try and sort out. And if you go down this path, just be aware that it can take months, and it could take huge legal bills to try and sort it out. So you need to decide, I guess, at the outset, whether the complicated capital structure is something that acquirers are likely to live with, or you're going to have to bite the bullet and simplify it. And the best people to advise on this are your investment bankers, who have seen this kind of thing many times before and have a pretty good sense of what kind of corporate capital structure is likely to prevail. Then we come to the data room, and typically this is a virtual data room where all of the documents are online. And so a data room will be a set of online folders and subfolders that store all of the material corporate documents, many of which we have talked about. So the idea here is for your corporate secretary or your CFO is to create and maintain, excuse me, an online data room before starting the exit process. And what this will contain is a full set of valuable corporate documents, which I'll explain in a minute. Now, during the exit process, every acquirer has their own format for looking at the important material documents. And so the idea here is that you can incorporate and create a separate Dropbox for each different suitor with their agenda for the material documents in that Dropbox, and you can copy your own documents over into their Dropbox so that each suitor gets their own exclusive folder formatted for their convenience, containing all of the same material documents. You maintain one for each acquirer so that you can keep track of which documents have been given to which acquirer, while maintaining for your own purposes your own master set of material documents in the company corporate Dropbox directory. So it's not as complicated as it sounds. Basically, you start with your own folder and then you populate the acquirer's folders as they ask for documentation. Now, the data room itself could be quite complex. There could be anywhere between dozens to hundreds of documents, depending upon how far along the company has grown as a corporate entity. And what these documents do is give a complete picture of the company, both good and bad. Anything and everything that might be important to acquire in determining the value of the company should be in the data room, because the acquirer has the right to full, plain, and true disclosure, and that means showing them all of the documents, whether they're good, bad, or indifferent. And it's very important to appreciate that as founders of the company and the chief the chief executive and other chief operating officers, they are going to be required to give a legal representation at the end of the day, certifying that all of the documents are complete and accurate. And it's a legal representation. And if you cannot give that, the exit will not transpire. And if you do give it, and then you find out that there's something wrong with those documents later down the road, then there are remedies for that that the acquirers can rely on in terms of reducing the purchase price or requiring the acquirers to give up something or give up some money or some other aspect to try and paper over the problem in the documentation. If the problem is serious enough, this newfound document, which is not to the advantage of the company, it may end up may crater the acquisition. So again, very important that the data room contain all the material information on the company, whether it's good or it's bad, and to make sure that the acquirer has the ability to access all of that documentation should they so desire. So let's look at what may be in the data room that's going to be important, that constitute the material information that the acquirers are going to look at. So in terms of category one, the human resources documents, you're going to need to see the resumes and summary bios of the senior management team and the directors, all of their social media contacts on LinkedIn, Twitter, and Skype, and their cell phone numbers. Very importantly, their employment agreements, and inside those employment agreements, as we mentioned at the outset, there should be non-disclosure agreements and intellectual property assignments as part of the employment agreements. And if they're not, you'll have to create them and include them in real time in the documents for the benefit of the acquirers. Any options and share ownership agreements that have been issued and need to be in there. The latest organizational chart. Oftentimes, acquiring companies will look for security and credit checks on the executives to make sure that there isn't something in their dark past that may come out to hurt the company in the future. And any severance obligations that are required should an executive not manage the transition to the new company. The acquirer needs to know what the severance obligation is going to be to set it right by them. So, that's some of the documentation that's required. I mentioned the non-disclosure agreements that every individual and needs to have signed and put in place, but also any company that has looked at the technology or the intellectual property of the company, maybe in terms of a joint development agreement or a potential previous acquisition attempt, something like that. That any company that's looked at the technology and IP, they must have a non-disclosure agreement in place as well. And before you go too deeply into the diligence that the acquirer does, they're going to have to sign an NDA as well, and it's going to be much stronger than the one that's done in the normal course of business, because of course you're giving the potential acquirer, who could be a potential competitor at the end of the day, you're giving them access to the family crown jewels in terms of the technology. So a much stronger NDA for potential acquirers, but they're all part of the data room as well. But of course, you're not going to include the NDAs of another company in a different company's documentation file, because you don't want them to see who else is bidding on the company. Financing documents, we've talked about these, but these are category 1 because they happened in the past, and you should just bring them up to date and put them in the virtual data room and not have to think about them again. Any previous term sheets that have been approved by the board should be in the data room. All the share subscription agreements, lender agreements. If you're in the province of British Columbia, of course, many tech companies are eligible for EBC tax credits. They have to apply for them, and so those applications should be in the data room. If you prepared a pitch deck in previous times to support an acquisition, the pitch deck should be there. And the final versions of any collateral you developed by way of executive summary, one-page summaries, etc. All of those should be in the data room as well for acquirers to look at. Now, something that's a little more delicate is the product roadmap for the company. And this is a category 3 item that you'll only, I think, put together when an acquirer is getting serious about their diligence and getting ready to prepare a letter of intent. Because what the product roadmap will include is all of the historical, current, and future product releases, including explanatory notes on the growth and the platform capability, and any technical reports on the technological capability, competitive advantages, comparison to competitors. These are all things that are very, very near and dear to the hearts of the company. They really are the crown jewels, as I mentioned before. So you will only want to disclose them when you're very sure that you've got a serious acquirer that is looking at making a bid for the company. Product technical descriptions is something you should have prepared at the very beginning, but if not, bring them up to date now. These are technical descriptions on how the product works, so that when the acquirer is doing their technical diligence, they've got a document at hand that makes it easier for them to see how the technology is going to work, particularly as how it is going to be incorporated into the acquirer's technical products as well. So you're going to want to document the competitive advantages, because this adds value to the company, and something acquirers may or may not appreciate until you tell them. A very, very important part of the documentation that you need are your patents and a discussion of them. So any patents that have been awarded, and a discussion of what those patents actually do in terms of protecting the intellectual property of the company, the list of any trademarks or trade secrets, any patents that are in prosecution, and indeed that's probably where most of your patents will be, because the patent approval process can drag on for years, but a list of all of the patents that you have submitted to regulatory patent offices, Canada, US, the European Cooperation Treaty, Patent Cooperation Treaty, all of those patents need to be disclosed and kept in the virtual data room. Now, something which you may not have, but if you can get, would be extremely valuable, is a formal analysis of the strength of your patent. It's very, very expensive to do so, because you'll need a qualified patent attorney to do the analysis. But what it will do is prove to the ability of an outside qualified observer to document what the strength of the patents has in the protection of the markets that you're trying to penetrate. So it's an extremely valuable piece of information if you can get it. But again, it's very, very expensive, and you're not going to do it until you're relatively sure that you've got a bona fide acquisition that's about ready to make an offer. Material contracts are large contracts that are material to the ongoing value of the business. So it wouldn't be every single sales order, but any distribution agreements, long-term development agreements, contracts that represent a significant component of the revenue of the company, distribution and reseller agreement, even your corporate leases or any obligations to spend money that are not otherwise listed. These are the types of material contracts that should be copied and put into the virtual data room because they are important to understand the conduct of the business and again, how valuable it may be. The next item is the sales funnel. This is a category 3 item. Because it changes all of the time, you'll want to bring it up to date just at the time that you're launching the exit process. And you've all seen what this is. It's a list of all the potential customers in the pipeline, the size of the order, and over what time frame you expect the order to close, what products that they're buying, and where in the pipeline they are, the expected close date, and the probability at this point of the close. So it gives a sense of the book of business that's sitting in front of the company. And by the same token, the customer list, these are the names and particulars of the actual companies that have bought the products, what they've purchased, their average order size, their last order. And as I mentioned, copies of major contracts. And note that if the contract is particularly large, then it should be approved by the board as a part of proper governance. And this customer list, again, because it's proprietary to the company, may be among the last documents that you disclose during the diligence process. Marketing documents, looking at the product brochures. Typically, these are all online at this point. You'll want to have analytics, either by Google Analytics or other web analytics tools that looks at your website traffic. So to the extent that you're an online business, your website traffic is absolutely critical to understanding the value of your business and how it's likely to unfold. In addition, any white papers that you've written that discuss the industry and how your products fit into it are very valuable. And any third-party estimates of market size, such as with Gartner, Forrester, IDC, these can help the acquirer understand where your company fits in the overall mandate or the overall scheme of the industry. And of course, that helps them decide how valuable it is. We're getting close to the end of the disclosure here, and I apologize. It is a lengthy list, but I hope it's giving you an idea of the amount of work that's required to prepare your company for its eventual exit. And again, the more you can do in advance, the easier it is come exit time. So we look at the financial obligations of the company. So obviously your lease, it's a very material part of your expenses every month, unless of course you're a virtual company and don't have an office lease. And that's a whole other presentation, which I'd be happy to give you at some point. Any obligations that you've undertaken with your patent counsel for future filings and filings and information required to keep the documentation up to date. These can be significant expenses, and so you need to document them and make them available so that your acquirer knows what they're taking on when they buy the company. Any of the insurance policies, you'll typically have business insurance. You may or may not have directors and officers or errors and omissions insurance, but if you do, keep those in the data room as well because your acquirer is going to want to see them. Now we look at some of the collateral that you're going to need to prepare to promote the acquisition. And the first item is a confidential information memorandum, or CIM for short. There was a time not too long ago where you needed to have a fully fledged business plan written, which could run to 40 or 50 pages with appendices to go in the back after that. I mean, the total document could be run into the hundreds of pages, and that was what was expected not too long ago. But in our practice, we've seen that business plans have virtually disappeared from the financing landscape. Replaced instead by something called the CIM, which is a very short form document that your exit advisor, investment banker will help you prepare, which is the key marketing document for the company exit. All the acquirers are going to want to see this. And what it essentially does is to summarize the business in a very small number of pages to indicate why the company is different and better than its competitors, what its value to the acquirer should be, and it should include the graphs from the financial model so that in a very quick period of time, a potential acquirer can decide if this is a company that he wants to spend more time on. Now, as soon as I've said that that acquirers are looking for a SIM, many in fact dispense with the SIM as well, and look only for a confidential information presentation, which is essentially a pitch deck, which would probably be 10 or 15 slides long, which would give the same quick picture of the company that a SIM would, but in a graphic and much more compelling form than a CIM would be. So it's a teaser document to quickly and inform and engage interest. And sometimes companies will want to see a one pager just to have a document that they can refer to as they pass it around the office. This would be a category 3 item that you'd only prepare probably if an acquirer asks for it. And it's a point form summary of the SIM all on one page. And in bullet form, it should describe the company, its products, its competitive advantages, include summary financial graphs, a list of the patent titles, brief founder bios if you have room for them, and other critical information that speaks to the value of and the structure of the deal. So a long presentation, and I apologize for taking so much of your time. Hopefully this has been valuable to you. So just to summarize what you need to do to prepare for an exit. In summary, the markets are very hot right now, and it's a great time to be executing an exit at this point. Markets can cool quickly. We saw that in March 2020 when the pandemic hit, and virtually overnight, the M&A markets cratered. They bounced back very quickly after it became apparent that the pandemic was going to be brought under control at some point in the future. And with all of the cash that is and still is floating through the system, the M&A market quickly regained its strength, and in fact is setting new records as we speak. There's lots of work to do to get ready for an exit. There's items that you need to clear up and get done in advance. Category 1, there's documentation that you need to continuously prepare on a monthly basis, like your financial statements. You try to keep it as simple as you can so it doesn't take too much time. Category 2, and documents that you prepare at the time that you're launching your exit. All of the documentations in your virtual data room, your financial statements, and very importantly, the financial model. And the collateral in terms of the SIM or the SIP or the one pager that the acquirers are going to look for. And the nice thing is although this is an awful lot of work, an experienced exit advisor can do an awful lot of this work for you and certainly guide you during the process so that it's as efficient as possible. And with that, I will close the presentation. And thank you very much for the time you spent today looking at this. Hopefully you've gained an appreciation of the preparation you need to do to get ready for an exit. And please feel free to contact me, David W. Rowett, and I'm at Strategic Exits, which you can find at exits.com or at the cell and email addresses below. I'll leave the presentation run for a minute or two so that you can write those down. And please, I'm certainly prepared to answer your questions at any point in time. Again, thank you for listening to the presentation, and I hope it's been of value to you. Bye for now.